We start today's market talk. Reason for the caution on equities is the fragile nature of the peace in the Middle East. Today, again, they are at each other. Iran has fired on some ships, and the US has retaliated and all that. So, the peace is very fragile, and that is the reason people are cautious. And also, Israel hasn't moved out of Lebanon. Iran is still firing at ships that don't obey their orders. Only thing is that the crude prices have come down. So the Hormuz is not really fully open, and that is the fear which is there with equities right now. Now, market outlook. So if you see, Brent dropped as low as $73.22 a barrel, almost entirely wiping out the jump from when the war started at the end of February. So if you see, Brent crude went up to around $120 and has come down. It just bounced a bit, but still it made a low of 73 and it's on a straight downward trajectory and it has fallen around 9.5% last week. So 40% decline from the high on as of high which was made on 30th of April. So Brent crude has come down. Next is US 10-year yield dropped to below 4.4% yesterday. So if you see, the US bond yields have also come down below 4.4. So it is notable because it comes after a surprisingly hawkish turn from new Fed Chair Kevin Warsh. So I'll discuss this slightly later. In the Indian markets, the Nifty is still down around 8% year to date. INR is at 94.3 to the USD against around 90 pre-war. And the 10-year Indian government yield is marginally higher than it was at the beginning of the year. So now let's see this. Nifty at the beginning of year was somewhere closer above 26,000. So it has fallen roughly 10%. Indian markets, though, have rebounded from March lows, but rebounded by around 10%. So that is one. Second is if you see dollar rupee has strengthened. It has come down to 94.3 and below the trend line. So that is positive. And bond yields have come down. So they have come below the trend line, which was a declining trend line. It had crossed that declining trend line. So the market was pricing approximately 2 rate hikes. So those have been discounted and now it has come back to 6.77. And if you see pre-war also, it was somewhere around these levels. So we are back to where we were. Other than equity, mostly it is taken care of. So lower crude prices, gains in rupee. There is a case for FIs to return to India, but let's see what are their concerns. And economists are talking about now higher growth rates and lower inflation. Now, the question is the benefit from the lower oil prices mostly priced into the markets by now? Now, Indian markets have rebounded by approximately 10% from the lows. With what is now likely to take place is that equity supply is likely to rise because there are few big IPOs planned and there is a chance of moderation in domestic flows and unlikelihood of FPIs coming in big ways or reversing in a meaningful way near term. They may just reduce their selling, etc. So, in my opinion, the broader market returns seem fully priced. That means as of date, we are fully priced. So the benefit is taken care of. Now, what can happen from here is very interesting. So the question is the AI bubble about to burst? Now, this first we must understand, we have discussed till government bonds. What is the correlation between US 30-year yield, US 2-year yield, gold, Bitcoin, dollar index, and AI trade? Now, US 2-year yield is highly sensitive to immediate Fed policy. If the market prices in upcoming interest rate hikes, the 2-year yield surges rapidly. Now, if you see the US 2-year yield, From the lows in March of around 3.4, it has gone to around 4.2. So the US overnight rates are between 3.5 to 3.75. That means short-term yields are pricing in two rate hikes already. So that is the first point, that the US two-year yield is high because they are pricing in upcoming interest rate hikes. Next is the US 30-year yield, driven by long-term growth, structural inflation expectations, and the term premium, the extra compensation investors demand for holding long-term debt. Now, if you see the US 30-year yield, it is declined. It had gone up to 5.2, it has come down to 4.8. So it has also declined approximately 30 basis points. Why it is falling? It is because of the wash effect and Fed credibility. What happened is the Fed chair has communicated a strict, unyielding commitment to fight long-term inflation. It reassures bond investors so that they believe Fed will suppress long-term inflation. So he says that 2% inflation is very important for us. So if the people are thinking that long term there will not be higher inflation, so for long term they don't want higher yield, so people are selling off. Other reason is uh, markets are pricing a peak in energy-driven inflation and geopolitical cool down. And also, when it went to around 5.2, a lot of people bought it, and now they are booking profits. So market is also pricing a slower economic growth due to higher short-term policy rates, because as I showed you, two-year yields have gone up by approximately 50 basis point, and there is some short covering, etc., which is taking place. Now, let's come to the next part, yield curve implications. When two-year yield rises faster than 30-year yield, the curve flattens or inverts, a classic sign of restrictive monetary policy and impending slowdown. So what is the market pricing in is that the bond yields are rising in US, hence the growth will slow down, and it is rising faster. So the difference, that is the yield curve, difference between 2-year and 30-year is reducing. Now, as I showed you in terms of Brent crude, so if the Brent crude prices go down, the long-term yields will still fall further. So this curve will reduce. But if the Brent crude price go back up, then the long-term yields will again start rising, and the curve will increase. So the yield curve is changing, and this is the one which is another issue which is creating a fear among the people. When the US short-term yields rise relative to foreign yields, capital flows into the USD seek higher risk-free returns, strengthening the dollar index. So the US short-term yields are rising relative to the foreign yields. So the capital flows are coming into the US. And if you see the dollar index is rising. Now, because the dollar index is rising, the Bitcoin is going down because people are investing more in the dollar. So the short-term yields have risen relative to foreign yields. Capital flows into the USD seeking higher risk-free returns, strengthen the dollar index. So both gold and Bitcoin are priced globally in USD. A stronger dollar mechanically makes them more expensive for foreign buyers, dampening demand. Furthermore, a rising dollar index typically represents a tightening global liquidity, which pressurizes risk assets. Now, the Bitcoin thrives in a low yield, easy money environments. When the 2-year yield and dollar index push higher, reflecting tightening financial conditions, Bitcoin routinely faces downward pressure as speculative liquidity evaporates. So, what is happening is, as the short term yields are going up, the yield curve is inverting. That is, the difference between 30-year yield and 2-year yield is reducing. The dollar index is climbing up. Because of that, the Bitcoin is selling off, the gold is selling off, the silver is selling off, and the copper is selling off. So now what you have to watch is, if the crude remains low, but what happens with the US 2-year yield? If the 2-year yield keeps going up, then as the short-term interest rates keep going up, then the gold, silver, Bitcoin, etc. will keep selling off. And now the AI trade comes into play here. Valuation for AI companies are built on massive projected cash flows 5 to 10 years into the future. When the 2-year yield is high, the discount rate used by Wall Street analysts to value these future earnings increases. Mathematically, this shrinks the present value of these future profits. So, when I was talking about is the AI bubble about to burst, what is coming out is that the revenue gap is getting uncomfortable. That is, also you have to divide the AI trade into three parts. One is the hyperscalers, second is the memory people, that is SK Hynix, Samsung, Micron, and third is the one who are making the chips, that is TSMC, etc. Now, what is happening is that the cost for hyperscalers is going up because the memory prices have gone up. And it is becoming uncomfortable because they are expected to pour in $660 to $690 billion into infrastructure and data centers, while the revenue is just 4 to 5% of this spend. So most organizations are struggling to see a measurable return on investment from their AI pilots. Hence, Nasdaq is choppy. Foreign stock market is moving up and down like a penny stock, falls down 10%, 12% in a day. Then there is inflation because the memory prices have gone up. There is a AI generated inflation flagged by Apple, increasing the cost of MacBook and iPads due to rise in prices of memory chips. So if the AI infra spending remains robust, it will further boost inflation and force interest rates higher. So if the earnings are very far and they have to borrow, and in addition, what is happening is all these AI hyperscalers, they are also issuing bonds because their expenditures are very, very high. And earlier, what they used to do was that they used to have a lot of free cash flows. Now that cash is going into infrastructure or capex, and they have to borrow more money, and they are issuing bonds. So Alphabet's debt has crossed 100 billion. Nvidia raised 25 billion. Hence, one has to be very careful because moment any one of these AI hyperscalers announces a cut in capex because of the availability of money or higher cost of money they are likely to borrow, then there will be a big sell-off. And this is also related to our gold and silver debt as investments because cost of funds, that is interest rates, is an important aspect. When interest rate rise, the gold tends to fall, and which is what you're seeing now. Both US and Indian markets have announced mega IPOs. Markets get boosted ahead of such corporate actions. So even though geopolitical uncertainty is a bullish trigger for gold, but higher interest rate is a very big negative for gold. So in my opinion, look at all the supports and take a multi-year view rather than a short-term trades in gold, because gold as a investment will not go because the US borrowing will keep increasing, the central banks will keep printing money, and in an environment which is inflationary, gold is the basic hedge against all these currency debasement, etc. So you should treat that as an investment, not for short-term trades. So every dip is a decent opportunity to buy gold. So we have covered these three important aspects. Now coming to FIs data, FIs covered shorts on index futures, bought calls in index options, sold puts. So if you see, they have covered shorts on index futures, bought calls, sold puts in index options. They are still medium bearish because net positions are negative. Now pros, they added shorts, sold calls, bought puts in index options. So they are medium bearish. While clients, they are long on index futures. They have bought calls, sold puts in index options. So they are strongly bullish. Now coming to the monthly data, FIDI data. Now, if you see here, the FI short positions have remained generally the same over this week, 4 trading days, and they are just vacillating in this range. So it started at 24,103 and ended at 24,056. So not much of change in their positioning and all. As per the news flow, they are just adding or selling calls, but there is a decent trend of short covering which is taking place, though they may not be adding new long positions. Now, in terms of US indices, they corrected due to sell-off in semiconductor and other mega tech stocks. And SpaceX also lost around 11.3% this week. Even Micron, after posting phenomenal third quarter earnings, saw losses this week. The reason is as inflation is rising, the 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 future earnings get discounted at a higher rate. Hence, the present prices or the present value of the stock goes down. So, core personal consumption expenditure has risen. Personal income and spending exceeded expectations in the US. US GDP estimate for Q1 was revised up to 2.1 from 1.6. So if you see, the US market has corrected. It's not a like a sold off, etc., like others. Similarly, Nasdaq, it has fallen down. It has fallen 4%, but it has come down to the rising trend line level only, and I think it should find support somewhere closer to the 20 EMA. And Dow Jones continues to go up because the other segments of the markets are now started performing, and the RSI is also high. So nothing to worry here. Now coming to Indian markets, VIX was declining. It just made a doji kind of thing. So it's at around 13, but nothing to be panicked. There's no panic here right now. Nifty 50, if you see on the weekly chart, it made a high wave candle. High wave candle is if you don't go anywhere, but you have very long wicks. So for second consecutive week, we are having a similar kind of a pattern. Shows indecisiveness among market participants. On the daily charts, if you see 4 days, it has traded above the 20 and 50 EMA. So the short term trend is positive. Daily RSI is, you see, sideways. So index is likely to remain range bound. So the resistance is 24,250, where it went and turned back from there to 24,300, and the support is 23,800 to 23,750. Nifty Bank, similar chart. Profit booking at a high, it made a high of 58,706, but it's a stronger index. Basic reason is because of all this FCNR money is going to come to the bank, so they will be having no problem of deposits, adequate money to lend, and the bigger banks are going to get bigger amount of money. So it also similar high wave. It made a high wave candle. Large shadows or wicks showing indecisiveness. On the daily chart, it is trading above all the moving averages, went up a bit. RSI is bullish. Resistance at 58,700, 58,800, support at 57,500, 57,400. So it's in a range. Recent up move is due to short covering rather than fresh long build-up, as you can see from FI positioning also. So if you see here, now the mid caps went up but sold off around 1%, but they are still doing much better than the bigger indices and small caps also. So the money is moving into this segment of the market where there is better earning growth. Now, if you see the major stocks, HDFC Bank moved up. It's facing resistance at around 800 level. So it has to trade above this level to move up. Reliance, it has gone above the 20 EMA. So that is positive. It should trade above this 1310 odd level for showing some strength. Otherwise, it has taken support at this 1250 levels. Like last time we discussed about Hitachi Energy, it has broken the rising trend line. So in my opinion, with the expiry coming up in 2 days, there would be some kind of action on this stock. Hopefully, it should take support around this 50 EMA or worst case 100 EMA, which is 30,000, but around 33,000, it should find some support. Uh, the stock which is in strong momentum is Interglobe Aviation. It has broken out through a symmetrical triangle pattern, and it has gone up. It is moving inversely against the crude prices. So now it is slightly overbought, but every dip is a buying opportunity here. It has filled this gap, so now it may go and test that 6,000 odd level where it was there earlier, and it has gone up with good volumes also. The sectors which are looking good is private banks, financial services, auto, pharma, etc. And among stocks, CG Power, Mahindra and Mahindra, Maruti, Shriram Finance, TVS Motors are looking bullish. Uh, Now coming to stocks, I'll cover Ather Energy first. Uh, Oil shock in 2026, sharp rise in oil prices, government emphasis on reducing oil dependency have created bullish tailwind for EV sector. Its rapid scale up in volumes reaching, so it sold around 262,000 units in FY26, is supported by a fast expanding distribution network of 650 to 700 experience centers and over 6,000 Ather grid charging points, strengthening its presence beyond core southern markets into North and West India. So it's a basically South India play, and now it is trying to expand into Maharashtra, Gujarat, and Northern India. The Rizta model accounts for over 70% of the monthly volumes, has successfully expanded the addressable market beyond premium urban adopters into mass family segment. See, earlier it was a niche kind of a model. Now they have realized their mistake and they have come out to the family kind of model, which is at a cheaper price, which is called Vista, which is basically 70% of monthly volumes. This growth has been reinforced by strategic platform expansion, EL platform, and frequent product refresh cycles. Its moat is built on an integrated ecosystem spanning vehicles, software, charging infrastructure, and distribution, enabling tighter control over customer experience and higher switching costs. It is gradually shifting from an aluminum heavy chassis used in performance focused model towards steel based chassis in its EL platform, which is better suited for mass market products. This transition is critical as the steel reduces input costs significantly while maintaining adequate structural strength for family scooters. It remains in a capital intensive growth phase. Current profitability profile is driven by sustained investment in product development, distribution expansion, charging infrastructure, and manufacturing scale up. Financial progression highlights a clear operating leverage led turnaround with profitability inflection from FY28 expected onwards and structurally improving earnings profile into FY30 expected, underpinned by scale benefits, localization, and expanding market penetration. So if you see overall, the EV sales volume have gone up overall, and in terms of market share, the largest market share is with TVS, then Bajaj, then Ather comes at 17%, then Ola around 12, then Hero and others at 17. So basically the auto guys, that is TVS, Bajaj and Hero, are able to use their networks much better. Uh, so Ola has come down and struggled to sustain volumes, lost share due to execution challenges, service issue, and intense competition from legacy players. In contrast, legacy two-wheeler players such as TVS, Bajaj, and Hero leverage their extensive dealer network, strong brand equity, and diversified portfolios to defend and grow share in both ICE and EV segment. But if you see market share trend analysis from FY23 onwards, the steepest rise is of Ather. So they have gained the market share the fastest as compared to others. And basically Ola has lost and rest everybody has been gaining. Now, in terms of volume trend, so if you see if this is the industry growth, Ather is outperforming in terms of volume. Product mix, as I told you, 72% is Rista family scooter, 4 and 28% is 450 platform, that is premium. It follows a two platform strategy with 450 platform anchoring brand and performance, while the EL platform drives volumes and scalability. The launch of Rista has shifted the mix towards the mass family segment, 70% plus contribution, expanding the addressable market beyond premium urban users. Remember, as I told you, in FY26 they sold 262,000 scooters. Okay, so Ather FY26, if you see Q4, 76% revenue growth, 76% year-on growth in units sold. Revenue from operations per unit is 1,40,000 and cost of goods sold is 1,08,000. So it has declined because of the various measures they have taken. So gross margins have improved roughly 700 basis point to 25%. EBITDA is up around 2,000 basis point, and now it is though it is still in minus 2.5%. Units sold 83,000 in last quarter. So if they say sell around 80 or 1,000 units in every quarter, so they should be able to sell around 3.2 to 3.5 lakh units in India at least per year. Pan India market share has grown. 700 experience centers expanding presence in India, and number one surged EV brand in Q4, which hardly matters. So if you see, the experience centers have gone up, the market share has gone up very fast. Uh, Wholesale, because of wholesale volume growth, and if you see here, 76% growth in wholesale. So if you see FY26 versus FY25, so every quarter they have gone up above 50% is the growth. So very strong growth in terms of grabbing market share. Now these are their scooters. Ather 450X, this is a premium performance scooter. Then Ather 450S, entry performance 450 platform. Uh, the real world range is at least 100 kilometers or 95 kilometers, so that surety is there. Then is Rista EL platform family scooter. Here again the range is the same, price has come down from around 1.45, 1.6 to 1.2 to 1.3 to 1.1 to 1.25. And Ather Rista Z, another model which is slightly costly because the battery capacity is higher. So the real world range is higher, it's a lighter scooter. Now let's see the margin profile. Now if you see, EBITDA is improving, reflecting investment and capacity expansion and network build out. EBITDA margins are also expanding. So if you see here, EBITDA margins are going up and they should turn positive in FY28. Net profit, uh, so net profit is improving, losses to narrow, turning profitable in FY29. That is where they will turn profitable. Net margins are also improving, so they should be positive in FY29. So it's a basically operating leverage led turnaround. So the basic fixed cost is taken care, and then as they grow the business and sell more scooters, it will become profitable. Coming to cash flow, strong free cash flow generation. So FY28 to 30, the cash flow should improve. Strong cash generation as volumes and profitability scale. And as I showed you, the gross margins have improved to around 25%. Free cash flow turns positive in FY28. Uh, it is FCFF is free cash flow to firm, and cash flow to EBITDA percentage is also improving, turning positive in FY28, reflecting fixed costs are absorbed over higher volumes and profitability base expands. Uh, Next is payable days. Payable days are projected to gradually normalize from 105 to around 98 in FY30. So there that days are coming down. Inventory days are stable at around 35. So that is not a problem. So it's a capital light, cost efficient operating model. ROE to turn positive in FY30 and ROIC to turn positive in FY29. So this is the basic stuff for them. It's a classic high growth EV OEM pattern where capital intensity upfront suppresses return in initial phase, followed by sharp operating leverage driven ROE, ROIC, inflection as scale profitability and capital efficiency converge in FY29 and 30. So you have to watch for that. Now they are increasing capacity. They presently have a facility in Hosur, two facilities where the capacity is 4.2 lakh units right now. And they are increasing their capacity. So they are making a plant in Auric, Auric is Aurangabad Industrial City, where it will be vertically integrated. So they will do everything there. So they will do 5 lakh in phase 1 and 5 lakh in phase 2. Total capacity should commence by in second half of the year. Uh, and they should be able to then sell slightly more scooter, and demand and supply gap should get covered. Now, if you see their earnings, see they have done around 5,000 crore. They are likely to do 5,000 crore in FY27 from 3,671 crore in FY26. So that's a growth of around 38%. And then they, as the more capacity comes up in FY27, then it is expected to double and so grow up by around 5,000 crore every year. So let's see what happens. Margins will improve will become positive in FY28, and it will become profitable in FY29 because of higher capex costs, etc. Total debt to equity is rising because they are expanding their facility, and there is so much of upgrades which are taking place in terms of technology. Return on equity should be positive in FY29. EV to sales is around 7.1. So if you see here, enterprise value is around 39,000 to 39,500 crore. So market cap is around 38,000 crore, debt is around 3,671 crore, and 2,400 to 2,600 is a net cash. So net enterprise value is around, say, let's assume 39,000 crore. So to the sales, it is 7 times, which is reasonable if you want to, because it's not making profits. So if you want to, below 10 is reasonable, and it is coming down. So it's not expensive right now. Ather Energy, it listed somewhere around 400 odd, and then it has seen a steady rise, and now it is poised at around at a cusp of 1,000 odd. So in my opinion, every dip is a buying opportunity up to 960 in this stock. Next is Quality Power. It provides premium equipment, dry type shunt reactors, line traps, harmonic filters required for major HVDC links. It produces dry type reactors and battery energy storage systems, power conversion systems engineered specifically for data centers. It acquires specialized complementary entities like Meru Electrical, Endox, and recently Win-Win Specialty Insulators. Switch off your volumes to control entire component value chains rather than banking entirely on slower organic greenfield setups. So their basic thought process is to acquire companies instead of trying to create facilities from the start. So that's why they save time. Its standalone business houses reactors and coils. Meru manufactures high voltage instrument transformers. Turnkey based Endox provides power electronic solutions such as SVC, which is static variation compensator, and StatComs, etc., which are static synchronous compensator. Basically, they inject or absorb reactive power to maintain a stable voltage profile across the various instruments they are supplying power to. And DESS power conversion systems are also made at Endox, and the proposed uh, Win-Win Specialty Insulator WSIL acquisition adds ceramic and polymeric insulator. So they are covering all the aspects of supply which are required for HVDC. It supplies customized products to global OEMs and utilities, including GE Vernova, Hitachi Energy, and Siemens Energy. So they are basically suppliers of these 3 large entities. The WSIL acquisition, it intends to target exports market where high voltage insulators command materially better realization. Management expects to stabilize and turn around the facility over the next 6 months and is targeting revenue approximately 200 crore from WSIL by FY28. A planned 8x capacity expansion at the new Sangli plant raises peak revenue potential to 1,500 to 2,000 crore from 250 crore. Commissioning is due by mid 26. That is their standalone plant of Quality Power. Management has guided for 15 to 20% revenue growth in FY27 as new commission capacities are commissioned and qualified, followed by sharp 50% plus acceleration in FY28 as these businesses begin to scale. EBS forecast is 30% growth for the next financial year, driven by full year revenue integration from Win-Win Specialty Insulators and Meru acquisitions, alongside a massive scale up in their BESS division. It secured a major international order worth approximately 48.3 crores to supply high voltage reactors to a data center project in the US. This will open the door for high margin export revenue tailored to AI infrastructure build-outs. So now if you see the group organizations and brands, there in the center is Quality Power, which provides located in Sangli, Maharashtra. Then Sukrut, located in Pune, EPEC, Sangli, Mehru, Bhiwadi, Rajasthan, Edison, Sangli, Maharashtra, then STAP, uh, Alua, Cochin, then Nebiski, Chennai, Tamil Nadu, and Endox, which is located in Turkey. So they have a whole, they have acquired whole lot of companies to go through the complete ecosystem, which is there to supply the EVG, the transmission and distribution grid, which is being developed in India. Now, as per their acquisitions, so if you see from 2011 onwards, they acquired Endox, then SNS Transformer, then Nebeski Electric Power Equipment, TTDI, Meru Electrical, Sukrut Electric Company, then now Win-Win Specialty Insulators Limited. So that is their method. Key businesses at a glance, but their key three major types of or three major components are Quality Power in terms of revenue, then Meru and Endox. Right now, others are being developed. So this Quality Power provides reactor coils. Meru provides instrument transformers for switchgears, and Endox provides SVCs and STATCOM for the various facility. Now they are doing 8x capacity expansion at Sangli, which is for Quality Power, and expect this revenue to scale up drastically from here. So from around 250 crore, they're expecting it to go to 1500 crore. So that is what is the plan. Now, so if you see in the various components, they are supplying various aspects to for medium voltage AC, high voltage AC, GIS, FACTS, HVDC, etc. for various requirements of the whole system. So they are trying to cover with new acquisitions the whole setup. Now coming to their profit and loss statement, they did last quarter they did 138% year-on-year growth of revenue. EBITDA was up only 56.5% because the margins had dipped. Why the margins have dipped is because higher raw material cost and operational scaling expenses. So margins have gone down, and PAT was up 65%. For FY26, the over FY25, the revenue was up 156%. The margins though were lower, but the PAT was up 85%. So one has to watch for what happens to their margins from here in the next quarter. So in terms of Q4 FY26 performance, if you see the major components of where is Quality Power Equipments, then Nehru and Endox. So they did around 310 crore of consolidated revenue versus 130 crore in Q4 FY25. And FY26 performance wise, if you see Quality Power Equipment, Meru and Endox were the key performers. Rest are just coming up now. Consolidated, they did around 1,000 odd crore revenue for the whole year, and EBITDA margins though have declined, but as compared to FY25, but that is normal because the cost of material etc. has gone up. So we'll have to watch for their EBITDA margins from here. Order book is strong, roughly 1,400 crore as of 31st March, and it is distributed in QP equipments, that is Quality Power Equipments, Endox and Meru. Others are small. So this is where the order book is there for all three segments. Endox secured a large international BESS order of 152 crore, expandable to 292 crore to be executed by December 2027. So coil products and fax application 26 crore from power grid Corporation of India for current transformer through subsidiary Meru Electricals, and FACTS reactor order worth 197 crore, reinforcing customer trust in Q1 FY26. 200 crore 4-year framework agreement with Israeli clients for 161 kilovolt coil products and deliveries starting Q3 FY26 through FY30. Now, if you see the chart, it was at these 700, 800 level, then took off in April, then has come down after the results came because of margin compression, etc., and then has come up again. Considering 30 next quarter and the decline in margins, etc., somewhere closer to this 1050 odd levels, if it comes to, is a great buying opportunity, because one has to watch for how the execution takes place, how they integrate new businesses, and how the capex comes up, because even the Sangli capex has got delayed by 3 months. So whether this project starts, etc. So there are issues. So one has to buy these stocks when there is this kind of euphoria and it's overbought. So wait for it to dip. As it is, there is a correction which is taking place in AI stocks. So once it corrects, or these infrastructure stocks which are supplying to the data centers, so once it corrects, there's a decent opportunity to get this stock for longer term. I finished. We will take questions now.